Small business owners and those of you receiving a 1099 NEC, we have our tax tip of the day. And specifically, I wanted to talk about the different financial statements. One being the profit loss, which is what most people are familiar with. And then the other one being the balance sheet, which I have found very, very few people are familiar with. So what are the basics of these and how does this apply to you? The reason I wanted to bring this up is because the balance sheet serves two very big purposes. It's first off, in the name, balance. When you're doing bookkeeping and when you're doing your accounting records, you know that the accounting records are somewhat accurate, or you can have some confidence in them because of the balance sheet. Second thing that I wanted to point out is not every single transaction, whether that's money going into the business or money coming out of the business, necessarily lands on the profit and loss. Sometimes it will land on the balance sheet, which means if you don't have a corporation, you're not going to see that transaction show up come tax time, because you may not report the balance sheet, but that doesn't mean it's not important. And so really quick, the basics of a profit and loss. A profit and loss is over a set period of time, whether that's a quarterly basis, a monthly basis, or an annual basis. And you're going to have your revenues minus your expenses equals your profits. And that's the very fundamental understanding of the profit and loss. Your balance sheet is an equation that assets, so everything the company owns that wasn't written off as an expense. So an asset might be a truck, it might be a heavy piece of machinery, it might be office furniture, it may be an intangible asset such as goodwill or intellectual property. So everything the company owns that could help in producing revenue or cash flow, how was that funded? Which is the equal sign. Was it funded by liabilities, which is debt? Did you take out debt to buy these assets? Or was it funded by equity, which is investments from outside investors, the owners, or profits flow over into equity, what is called retained earnings. So profits that weren't paid out to owners or shareholders is retained in the company as equity. So once again, assets, everything the company owns, buildings, etc. How was that funded? Was it funded with debt, or was it funded by outside owner capital or profits that were retained in the company? And so those are the big takeaways, and why I wanted to bring this up is because when I was scrubbing books, getting people's books ready for tax season, I'm fixing a lot of mistakes, and the mistakes that I see is we would get expenses, right? So deductions wouldn't land on the profit and loss. They would land on the balance sheet because no one was overlooking the accounting system. And then vice versa, we would have owner contributions, which should have landed in equity, not in revenue, not as taxable income, once again, because someone wasn't overlooking the system, the accounting system. And so, like I was saying, oftentimes if you don't have a bookkeeper or a CPA that's really looking into these things, you could be missing a ton of deductions, or worse, you could be counting a lot of cash flow as taxable income that shouldn't be. And so those are the very basics, but as you can see, as your business grows, this becomes more and more important. So as you turn into an S Corp or maybe a C Corp even, understanding both of these statements and the timing of cash flows, the timing of tax deductions can also be very important for your tax strategy.